The market is closed, and the last reported price for SoFi Technologies Inc. was $29.78 from the close of the trading session on September 23, 2025. Now, a lot of people look at that number and see a stock that has been on a truly remarkable run, especially considering where it was just a couple of years ago. It's a classic fintech success story, a name that's synonymous with online investing and a new kind of consumer finance. But the simple truth is, the story of this company right now is far more nuanced than just the headline price suggests. The real tension isn't just in its recent price action, which has seen some volatility, but in the internal workings of the company itself. Specifically, the balance between its high-growth lending business and its lower-margin financial services and technology platforms. It's a structural dynamic that the market often overlooks when it gets caught up in the pure growth narrative. The market's expectation is that SoFi is a rocket ship fueled by strong loan originations and a new generation of members. The reality, however, is that this growth has been heavily dependent on a macroeconomic backdrop that is now showing signs of shifting, and the company's long-term value may ultimately be tied to a different part of its business altogether, a part that isn't as glamorous but is arguably more stable. The daily and weekly swings in SoFi stock are a direct reflection of this internal conflict. The stock can rally aggressively on news of strong loan originations or a new product launch, only to pull back when a new interest rate forecast or a report on consumer credit concerns surfaces. We've seen this pattern play out over the last few trading days. The stock has been bumping up against its 52-week high, hitting intraday highs over $30, which is a powerful psychological level. That kind of upward momentum is driven by trading activity and a surge of optimism. But the trading volume that accompanies these moves also tells a story of short-term institutional activity and retail speculation. The institutional holdings are substantial and have been increasing, but you can see from the daily charts that there is a consistent churn, a dance between large players taking profits and new capital coming in. This isn't a stock that is being quietly accumulated, it's a very public, very active market that reflects the ongoing debate about its true valuation. We saw a recent example of this dynamic when the company's chief technology officer made an insider sale of a significant number of shares. While insider sales can happen for a host of personal reasons, in a high-growth name like this, it can signal to the market that a key figure is cashing out, creating a temporary headwind for the stock price. The underlying sentiment is strong, but the actual flow of capital shows a market that is not just buying and holding, it's actively trading, trying to capture the momentum while hedging against the very real macroeconomic risks that loom. Now, let's step back and consider what the company actually does. SoFi is a multifaceted financial services platform that began with student loan refinancing and has since expanded its offerings significantly. Today, its business is essentially broken down into three main segments: lending, financial services, and its technology platform, which is primarily Galileo. The lending business is what most people associate with the company's early success. It includes personal loans, student loans, and home loans. This is the engine of its growth, generating a substantial portion of its revenue. This is where SoFi Invest, a key part of its financial services segment, comes in. SoFi Invest offers a variety of investment options, including stock and ETF trading, a SoFi robo-advisor, and even crypto. This, along with its SoFi Money cash management product and credit card, forms the core of its direct-to-consumer financial services. Finally, the technology platform, with its Galileo platform, is a fascinating B2B component that powers the digital infrastructure for a wide range of fintech companies and financial institutions. This segment is less visible to the public, but it's a high-margin, sticky business that provides a crucial layer of diversification and a powerful moat. The common narrative is that SoFi's strength comes from its ability to attract and serve a young, financially savvy demographic with a full suite of products. The idea is that a member who starts with a student loan can then be cross-sold into a checking account, a credit card, and a SoFi Invest account. This strategy of cross-selling, creating a unified financial platform under one roof, is central to their pitch. However, the reality is that the lending segment, while a huge driver of revenue, is also the most sensitive to economic conditions. When interest rates rise as they have, the cost of funding for SoFi goes up, which can put pressure on their lending margins. This is where the tension comes in. The company's future might not depend as much on the continued explosion of its lending business, but rather on the success of its other segments. The financial services and technology platform segments, while currently a smaller piece of the revenue pie, have the potential to become more profitable and less cyclical over time. They are what will ultimately distinguish SoFi from a simple lending company. The growth in these areas, particularly with Galileo's client base expanding, is a key metric to watch, arguably more important than the latest quarterly loan origination numbers. It's the behind-the-scenes part of the business that is quietly building a foundation of stability, even as the public eye is focused on the more volatile lending side. Let's look at the financial reports to get a better sense of this. In its most recent quarterly results, SoFi once again delivered strong top-line numbers, beating both revenue and EPS expectations. This has been a recurring theme, and it's a testament to the company's execution. They have consistently demonstrated an ability to grow their member base and product count. A key highlight was the accelerated growth in net revenue, hitting a record high and being driven not just by lending, but by a significant increase in fee-based revenue from the financial services and technology platform segments. This is a critical point that often gets lost in the headlines. The profitability of the company is also a major milestone. They've been consistently reporting positive net income, which is a huge step for a high-growth fintech name that was unprofitable for a long time. But the market's reaction to earnings is often a classic example of this expectation versus reality principle. They beat expectations, the stock rallies, but then it pulls back a few days later. Why? Because the market looks past the good news and immediately starts pricing in the next set of challenges, whether it's a potential for a slowing economy, regulatory changes, or increased competition from traditional banks or other online investing platforms like Robinhood or interactive brokers. The market's expectation for a company like SoFi is perfection, and any hint of a future headwind can cause a swift correction. From a trading perspective, the stock has been a hot topic on forums and investing sites, with many people using platforms like Robinhood or SoFi Invest itself to acquire fractional shares. This has led to a high level of retail investor interest, which can contribute to the stock's volatility. It's not uncommon to see large intraday swings, driven by social media sentiment and news headlines. For those of you who use Schwab Intelligent Portfolios or a similar service, you might have some exposure to SoFi through a fintech ETF or a broader growth fund. The question for many of these investors is how much of the growth story is already priced in. The forward PE ratio is high, reflecting the market's high expectations for future profitability. This makes it a growth stock, but one that is vulnerable to any misstep or change in the macroeconomic landscape. The conversation around this stock is constant, and it's a clear example of how individual brokerage accounts and self-investing have created a whole new kind of market dynamic. Looking ahead, there are a few key things to keep an eye on. The first is the ongoing interest rate environment. The Federal Reserve's actions will have a direct impact on SoFi's lending margins and the demand for new loans. If rates stabilize or even begin to come down, it could provide a tailwind for the lending business. On the flip side, if they stay elevated for longer than anticipated, it could be a challenge. The second is the continued execution of the financial services and technology platform segments. Can they continue to scale these businesses and increase their contribution to the overall revenue and profitability? This is where the long-term value of the company will be built. The Galileo platform, in particular, is a source of consistent, high-margin revenue, and its expansion into new verticals is an important catalyst. The third is competition. The consumer finance and online investment landscape is crowded. Firms like Fidelity, with its long-standing reputation and vast resources, and even other challengers like interactive brokers, all have their own offerings. SoFi's ability to retain members and attract new ones will depend on its capacity to offer a compelling, integrated experience that goes beyond just a single product. Its unique value proposition is the all-in-one financial dashboard, and they need to continue to deliver on that promise.
So in the end, what we have with SoFi is a company that is executing on its strategy and hitting key financial milestones, but the market's perception is constantly in flux. The expectation is a simple story of a high-growth fintech company that is winning over a new generation of consumers. The reality is a more complex picture of a company with a strong lending arm that is subject to macroeconomic pressures, balanced by a growing and more stable technology and financial services platform. The journey from a niche student loan company to a full-service bank has been impressive, but it's far from complete. The stock's price will likely continue to reflect this tension between a strong present and an uncertain future. It's a prime example of a stock where the narrative matters as much as the numbers, and the investor who understands both sides of that equation is the one that will be best positioned. Comment below what you think the most significant risk to SoFi's growth story is. Is it the economy, competition,